Students, in last videos I was discussing about the economy analysis and industry analysis and the factors to be considered for the purpose of investment under economy and industry analysis. So today in this video I'll be discussing about the company analysis, the factors to be considered for the purpose of investment under company analysis. An industry consists of hundreds of companies that may be producing similar products, yet their level of diversification, operational profits, and efficiency would differ. Within an industry, companies' risk and return profile may vary. The difference may be either small or big. An investor must choose the best performing company from among the group for his investment. For example, if he selects the information technology industry, then he has to choose between companies like Infosys, TCS, HCL, Wipro, Cognizant, Mahindra, Tech Mahindra, Oracle, and so on. For this, the investor has to assimilate several bits of information related to the company and evaluate the present and future value of the stock. The valuation process depends upon the investor's ability to look for the right information from the interrelationships of the company variables. What is company analysis? Evaluation of financial performance of a company on the basis of qualitative and quantitative factors is called company analysis. Qualitative factors are non-quantifiable factors that represent certain aspects of company's business. Integrating such information into evaluation of stock prices can be difficult. At the same time, they cannot be ignored. For example, the management factor is one of the qualitative factors. It is difficult to measure, yet it has a lot of influence on the profitability or even on the existence of the company. Some of the qualitative factors that affects the value of the company shares are business model, management, corporate governance, and the corporate culture of the business. The business model will describe the way in which company makes money. It may be simple or it may be complex. Even before making a financial analysis, investor must know what exactly the company does. Good and capable management teams generate profits for investors. The management of a firm should efficiently plan, organize, actuate, and control the activities of the company. The basic objective of management is to attain the stated objectives of the company for the good of the equity holders, the public, and the employees. If the objectives of the company are achieved, investors will receive profits. A management team that ignores profits does more harm to investors than one that overemphasizes it. Every public limited company provides corporate information on its website. Hence, the all positive aspects of the management will do good for the investors. Some of the sources of management analysis are conference calls, management discussion and analysis, management ownership of the equity stock. Corporate governance. Corporate governance refers to the set of systems and practices that are put in place by a company to ensure accountability, transparency, and fairness in dealings to safeguard the interest of the stakeholders. A stakeholder would be anyone like the directors, the management, or the shareholders, the customers, employees, or the society. The system and practices are defined and determined in the company charter and bylaws as well as in corporate laws and regulations. So it is important to analyze the corporate governance of the organization to see the systems and the practices that are put in place, whether they are favorable for investors or not. Corporate culture means the collective beliefs, values, systems, and processes of a company. It gives a company a unique entity. Every company has a set of values and goals that helps to define what the business is all about. The basis of corporate culture is expressed in terms of the policies and procedures adopted in the company's functioning. A strong corporate culture that enables adaptation to a changing market will lead to strong financial results. A corporate culture that values employees, customers, and owners and encourages leadership from everyone in the company is bound to perform well. If the customer needs change, a firm's corporate culture changes its practices to meet these new needs. Hence, all these factors have to be analyzed in detail for the purpose of investment. Quanti- Quantitative factors. Some of the quantitative factors to be analyzed from the company's perspective are earnings of the company, excuse me. So the quantitative aspects under the company analysis to be analyzed are the history of the company, how the company has performed in its past, who are its promoters and the management. And some of the questions to be answered are: how old is the company? Who are its promoters? Is the company is managed by family or professionally managed? What is the public image and reputation of the company, its procedures and its products, promoters and its products? Also, aspects like technology, facilities, and production also to be analyzed. And the questions to be answered are: does the company use relevant technology? Is there any foreign collaboration? Where is the unit located? Are the production facilities well balanced? Is the size the right economic size? What are the production trends? What is the new material position? Is the process power intense? Are there adequate management for power? So all these questions are the aspects to be analyzed. And under product range, marketing, selling, and distribution, some of the questions to be answered are: what is the company's product range? Are there any cash cows among the profile or product portfolio? How distribution effective is the marketing network? What is the brand image of the products? What is the market share enjoyed by the products in the relevant segments? What are the effects and costs of sales promotion and distribution? And under the aspects industrial relations, productivity, and human resources, some of the questions to be answered. How important is the labor component? What is the labor situation in general? And in the environment in which the company is operating, some of the questions to be answered are there any statutory controls on production, price, distribution, raw material, etc.? Is there any major legal constraint? What are the government policies on the industry to imports and exports of the final products and also for raw materials? If you get the answers for all these questions, then it would be better for you to take a decision whether to invest on such company or not. And also, internal to the company, some of the factors to be analyzed are earnings of the company, measurement of earnings, the gross profit, earnings per share, growth in earnings, price earnings ratio, financial leverage, and operating leverage. So the earnings of a company will decide the stock value in the market. The company pays dividends from its earnings. Growing earnings will result in high valuation of the stock. Sometimes the prices of the stock may be high but not the earnings. Why? Because the market anticipates a future rise in the earnings of the company. That is, in simple terms, earnings are the operating profits of the company. The income for company is generated through operating sources and also non-operating sources. Hence, it is important to find out the earnings of the company and also how you measure the earnings. So, hope we have discussed or you would have learned how to measure the earnings of the company. That is, we will arrive at the earnings after tax and also earning per share, starting with the cost of goods sold. And also, we should look at the growth in earnings. And also, we also have to analyze the financial leverage in the sense what is the proportion of the capital, that is the debt capital and the equity capital. Why? Because if the debt capital proportion is high, then the profits of the company would decline because regular payment of interest and also the timely payment of principal amount has to be made to the debt holders and also for the borrowings of loans from the banks. It's very important to analyze all these factors. Also, the competitive edge of the companies has to be analyzed. Major industries in India are composed of hundreds of individual companies. In the information technology industry, even though the number of companies is large, a few companies like TCS, Infosys, and Wipro control the major market share. Likewise, in other industries where some companies rise to a position of eminence and dominance, the large companies are successful in meeting the competition. So, some of the factors or competitiveness of the company can be assessed by looking at the market share of the company, growth of annual sales, and stability of the annual sales. Production efficiency means producing the maximum output at minimum cost per unit of output. This efficiency measures how well the production or transformation process is performing. Increasing efficiency boosts the capacity of a business without any change in the number of inputs employed. All businesses should try to operate efficiently. However, this is particularly important for a growing business. To withstand the competition, a business must be at least as efficient as its main competitors to survive successfully in the long run. A firm with stable sales revenue, other things being constant, will have more stable earnings. Wide variations in sales lead to variations in capacity utilization, financing planning, and dividends. All financial newspapers periodically provide information about the market share of different companies in an industry. The fall in market share indicate a declining trend for the company even if the sales are stable in absolute terms. Hence, the stability of sales should be compared with market share as also the competitors' market shares. A company may be in a superior position commanding more sales, but in monetary and physical terms, but both in monetary and physical terms, but the investor should have an idea of whether this will continue in future. For this purpose, he needs to forecast sales. So how he has to forecast the sales? There are many ways for forecasting sales. For example, by fitting a trend line, either linear or non-linear, whichever is suitable. Also, by analyzing historical percentages of company sales to industry sales, by comparing sales growth with macroeconomic variables like gross domestic product, per capita income, and population growth. Also, by analyzing the different components of demand for the company's product, since demand may arise from different sources, by analyzing demand for the substitutes and the competitors' products using the least square techniques. So all these techniques will help the investors in forecasting the sales. Then efficiency of the inputs is measured in terms of their productivity. In simple terms, productivity measures the relationship between input and output in a company. For example, labor productivity is measured in terms of the output produced or services rendered by them. Productivity of the employee or labor can be measured by output per hours or per day or per week. Productivity of the employees should be given importance. Upgrading the skills of the employees improves productivity. Providing relevant role specific role specific training to employees enhances company productivity. Hence, all these factors are very important in order to understand how the company is doing and how it would do in future. Financial analysis also is of huge importance. The best source of financial information about a company is its financial statements. This is a primary source of information for evaluating the investment prospects in a company's stock. Financial statement analysis is the study of a company's financial statement from various viewpoints. The statement gives the historical and current information about the company's operations. Historical financial statement analysis will help the predict future. The current information aids in analyzing the present status of the company. The two main statements that are used for analysis are the balance sheet and the profit and loss account. The balance sheet shows all of a company's sources of funds and also the uses of funds at a given point in time. It can either be in the horizontal or vertical form. Analysis of financial conditions of the company requires a report on the flow of funds also. The income statement reports the flow of funds from business operations that take place between 2 points of time. It lists the items of incomes and expenditure. The difference between the income and expenditure represents either profit or loss for the period. It is also called income and expenditure statement. Profit and loss account of the company helps the investors in analyzing the profitability or the profitability. Analysis of financial statements can be done using various techniques like comparative financial statement, trend analysis, common size statements, fund flow statement, cash flow statement analysis, and ratio analysis. So, apart from this, it is also important for an investor to analyze the company's SWOT, various aspects of the strength, weaknesses, opportunities, and the threats to be analyzed in order to understand whether it is good for investing in such companies. So, here is an example of the analysis of SWOT of the Facebook company. It is also important to analyze the company, or it is also important to analyze the industry using Porter's five forces model, so which helps either the company or the which helps the investors in understanding what is the rivalry position of the company in the industry, which are the substitute products, is there any threat of the substitute products, if so what is the level of threat, is there the bargaining power of buyers is high or the bargaining power of suppliers is high, is there the barrier of entry is high, average, or low. So, in order to understand these factors, it is important to analyze either the industry or the company using the Porter's five forces model. Profitability of the industry of the company can be analyzed using various ratios like gross profit ratio, net profit ratio, earnings power, return on equity, earning per share, and also profit and loss account analysis could be done using various ratios like we could study some uh, turnover ratios. So for the help of with the help of income statement or profit and loss account. So students, if you analyze or if you understand the EIC framework, then it would be more helpful for an investor for making investment for better profits. The end goal of performing fundamental analysis is to produce a value that an investor can compare with the underlying assets current price in hopes of figuring out what sort of position to take with that security, that is whether to buy or whether to sell. So with this, hope you understood about the fundamental analysis and its importance in making the investment decisions. Thank you for viewing this video. So in next video, I will be discussing about technical analysis.